So NVIDIA came through with $13.5 billion of revenue for $6.7 billion in the same quarter last year. That's over 100% growth. Now keep in mind, analysts thought NVIDIA was going to do 65% growth. NVIDIA was talking about they're going to do 60% growth. Analysts had them at 65%. And I even remember some big creators that I have respect for thought maybe NVIDIA was lying about their numbers. And it's like, why do you think they're lying? Like, NVIDIA's never been one of those companies to lie. Jensen's never been one of those CEOs to just make up stuff. There's are those individuals out there, but he's never been one of those. So if they say they're going to do 60% growth, they're probably beating that. Okay. Now, I don't think anybody had a clue that they were going to do 100% plus revenue growth. That's shocking, right? I mean, what are we talking about here? Like just insane growth numbers, right? As far as gross profit went, they over 3x'd on gross profit. Like what? I mean, the numbers are just shocking, man. I mean, just absolutely shocking. Over 3x on gross profit, like just to even wrap your head around that, it's hard to do. I mean, it's just incredible. Gross profit, if a company can raise their gross profit 10, 20%, that's great. You're winning. That's phenomenal. To 3x your gross profit on a year-over-year basis, like literally my brain's having a meltdown just looking at that number. Like insane. Net income almost 10x'd on a year-over-year basis. Almost 10x'd. Diluted EPS nearly 10x'd on a year-over-year basis. I mean, that's all we can do is clap. I mean, just simply magnificent. Creme de la creme earnings out of NVIDIA. It doesn't get better than that. And when I say it doesn't get better than that, I damn mean it. It doesn't get better than that. A 3x of gross profit, a nearly 10x of net income. Come on, man. A double up of revenue, just disgusting. Now, that might not even have been the best part of the whole thing. That might not even have been the best part. The guidance. They guided for revenue of $16 billion. Now, given that they just guided for 60% growth, they came in with 100% growth, you can assume that revenue might be ahead of $16 billion. Maybe they do 16.5, maybe they do 17, maybe they do 18. Who the heck knows at this point in time, okay? All we know is it's going to be a huge number. Analysts had expected this company next quarter to do $12.4 billion, which that was going to be over 100% growth. So, I mean, the demand for NVIDIA's products right now, especially their AI-related chips, is astronomically high, and they're going to be able to get any price they want for those chips in the short term, meaning over the next several quarters. I don't know about over the next 5 years, but over the next several quarters, they can get whatever they want for these chips. And there's no shortage of customers buying these chips right now, okay? Now, the big argument from the bears, and I have watched people all year buy put options on NVIDIA, short this stock and buy puts, and short this stock and buy puts, and short this stock, and just to be decimated time after time again, losing 100% of their capital again and again and again and again and again and again, okay? By the way, if you've been short in the stock this whole year, you've lost way over 100%. It's way worse than facing a bankruptcy because at least you buy a stock at $100, it goes to zero, you lose 100%. You short a stock and it goes up 200, 300%. Well, you probably aren't even around that long because you probably got margin called and your account got liquidated way before that. But here we are in this dynamic where the shorts and these bears have said, well, one, we think maybe they're making up the numbers, they're not going to come through with numbers. Well, that's out of the way now. The other thing was, oh, it's so expensive. It's so expensive. It's so expensive. Is it really? Is it really? Okay? Because here's the deal. Based upon these old metrics the analysts had, the company was trading at about a 55 forward P and about a 38 forward P for next year's numbers, right? Well. Guess what? This number's actually in reality way lower. You might be paying 30 times this year's numbers. Now, let's say you're paying 30 times this year's numbers for the company, right? Well, if the company has a triple-digit revenue growth, 10x type net income growth, you're getting the best deal in the history of the stock market, unless the demand is just some short-term thing and then it goes away. The fact is, NVIDIA is much cheaper today than it was yesterday. Yesterday, you thought this company was trading at a 55 forward P, when in reality, this company might be trading at a 30 forward P. In reality, this company is going to be way more profitable over the next couple of years than anybody anticipated, which means the stock is ultimately, if you're somebody that's interested in NVIDIA, it's actually a buy here today, even with the after hours move. Now, I'm not a buyer of NVIDIA stock. I have no clue how long this demand lasts for, personally. I'm not an insider of the industry. And so for me, I won't be buying NVIDIA stock. But at the end of the day, if you're somebody that understands NVIDIA stock, you actually have to be a buyer of this stock tomorrow, even at 500 plus, because the stock actually is trading cheap, unless you think like the demand's only here for today and tomorrow, and it's all going away. If that's the situation, that's a whole different dynamic, right? But for now, I mean, it looks absolutely glorious for NVIDIA, right? Talk about Bath & Body Works. Talk about if that's an opportunity to buy here, or if that's another one to just stay away from. And then we'll talk about what this means for the overall economy and where we're headed here in regards to that, okay? So Bath & Body Works, they just gave their 2023 outlook. They updated it, okay? So the company has updated its full-year forecast to reflect better than expected bottom line in the second quarter, the impact of debt and share repurchase in the second quarter, and narrowed sales expectations for the fiscal year. For fiscal 2023, the company expects net sales to decline 1.5 to 3.5% compared to 2022. So Bath & Body Works, the company that sells soaps and candles, they're also bringing down their numbers. Now, there's a huge difference between them and a lot of these other folks that have seen a lot of weakness recently, because a lot of the other folks who have seen weakness, they might be at the higher end, the $100, the $1,000 price points, At the end of the day, Bath & Body Works, like everything in that freaking store is like under $25. So yeah, not a great thing to see their sales declining as well, right? Company now expects full year 2023 earnings per share to be between $2.85 and $3.15. That was compared to $3.40 in 2022. So their numbers are coming down as well, right? And if you view this as a rolling recession, it's certainly rolling through the retailers left and right now, okay? Whereas last year it was really the tech companies were getting hit left and right. This year, it's these retailers, man. It is just bad. Company expects full year 2023 adjusted earnings per share to be between $2.80 and $3.10. The company's adjusted earnings per share forecast excludes a gain of early extinguishment of debt associated with the open market purchase and retirement of $199 million principal amount, right? And so that's good. Now, in terms of getting rid of some debt, right? But the interesting thing, back to Foot Locker, right, is let's say this is why it's so important that they had to cut the dividend. Because right now, do you want to take out debt right now if you're a company? No. I mean, interest rates are insane right now based upon anything you've had to pay in the past 20 plus years. So if you're a retailer, the last thing you want to do is have to take out debt right now, right? Which goes into the whole, well, let's just cut the dividend situation, right? Now, they have some big issues here at Bath & Body Works. Their direct business was down 10%, which is basically like their online business. On a year-over-year basis, international business is down 4%, right? Stores are down about 1%, which, yeah, I mean, anytime I've been to any malls or anything, I mean, stores look busy, so it's not surprised that that's kind of, roughly about what it was last year. But the scary thing is, man, if that store traffic starts to drop off in any meaningful way, geez, what are we looking at for Bath & Body Works numbers, right? Now, Bath & Body Works, $1.5 billion of revenue versus $1.6 in the same quarter last year. Gross profit fell to $622 million versus $660 in the same quarter last year. So the thing with Bath & Body Works when you start going through these numbers is it's not a disaster, but it's weakening. And that kind of reminds you of where Foot Locker was a few quarters ago. And it's like, oh boy, are we about to see a major weakness in a Bath & Body Works, right? Selling general administrative store expenses actually went up quite a bit on a year-over-year basis to $434 million from $418 million same quarter last year. That's not something you want to see, especially when your revenue is going down. Operating income fell to $188 million versus $242 million in the same quarter last year. Interest expense was in line. They had some other income there. Income before income taxes, $127 million versus $158 million in the same quarter last year. Net income came in at $99 million versus $120 million in the same quarter last year, and diluted EPS came in at 43 cents versus 52 cents in the same quarter last year. So, I mean, just to be quite frank, that's not good. Like, everything's pretty much getting worse for Bath & Body Works across the board. And once again, this is not a retailer that has to worry about taking out credit. You don't have to get a loan to go into Bath & Body Works. Like, you're going to spend $25, $50, whatever, right? And so it looks to me like Bath & Body Works might have to end up getting more promotional over this next several quarters as well. And if they get much more promotional, margins get hit, right? It takes away sales from full price products. So I wouldn't be surprised if you see a lot of Bath & Body Works bring back a lot of the old deals they used to do back in the day to incentivize customers to, buy a bunch of soaps at a huge discount and candles and things like that. So that's what's playing out there. And I also went by a Bath & Body Works store, a few weeks ago, and I actually took a picture of it and posted it on my Instagram story. And it was supposed to be just something funny, but it was actually might have been a little scarier than kind of thinking about it, right? I don't know if you guys saw that picture or not, but I posted this picture on my Instagram story of Bath & Body Works already had like Halloween stuff up, like the Halloween soaps and stuff. And we know like fall season is usually a huge selling season. So this was, a few weeks ago. So this was at the very beginning of August. So if you're pushing that product already out there at the beginning of August and not even waiting till September, October to kind of get that stuff in your store, the fall stuff, right? It almost shows that you're probably more desperate for sales right now to push out, your highest volume kind of products right now and let's get those in the stores now. That's a little worrisome in itself, right? And so, yeah, just, but you put these pieces together and it's not a great situation, right? Now, in terms of Bath & Body Works, so the company trades cheap, right? Very cheap forward Ps. But once again, the scary part of this is Foot Locker has been trading really, really cheap. Why do you think I was buying Foot Locker stock? The forward P has been like in the 10 to 12 range. But when you just keep bringing down your numbers again and again and again and again, can you trust the forward P, right? And so with a Bath & Body Works, it's like, do we trust these forward Ps to be true? Or are these too high? That's a scary thing right now. And that's where you're really taking a risk in buying any retailer right now, because all these companies are just seeing their revenue start to decline, some of them declining faster than others, EPS going the wrong way, net income going the wrong way. And so when margins going the wrong way. So when you look, you're like, dang, man, or is this a bottom for these retailers? Or do we have a lot lower to go? Once again, I take you back to the scary part of we're at 3% unemployment right now. And so that's a scary thing that, is out there, that is like, man, what if we had an unemployment situation that got much worse? Does that hit these guys even worse, right? What if we had another problem with inflation, which based upon these retailers, if anything, it looks like deflation's coming, okay? Because at the end of the day, these guys got all too much inventory. They're going to have to cut price to move volume, right? Which is more deflationary than inflationary. These companies are not in a position of power. You can go through the whole long list of them, all the way from the highest ends Louis Vuittons, all the way down the food chain to some of the lowest end you'll get in a mall retailer, which is Bath & Body Works, where almost everything in the store is under $25. The whole food chain right now is pretty much in a situation where, if anything, they're going to have to lower price, discount to get consumers to buy rather than sell at full price. They're not in a position of power. There's nobody that's in a position of power right now in all of retail. Think about that for a moment. Let that sink in, right?